Hi, this is Dustin with Dustin's Dollars, and today I'm going to be talking about the $100 million of equity funding, equity facility that Knightscope announced the other day. Going to be going over some of the details of this and giving just a little bit of my own thoughts and my analysis on this. So, before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do currently hold a long position in Knightscope. I hold mostly preferred S shares, and I hold a smaller position of the common stock, the Class A's. So basically, this video should be for entertainment purposes only, because I could be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. So, yeah, this was in my opinion, a pretty big announcement the other day. Knightscope had this PR they put out, and they finally filed the actual corresponding 8K today with the details, filed today with the SEC, so I could actually have something to talk about now. But $100 million over a 2-year period, and there's obviously some major caveats to that. It's because they even put in the PR, this is up to $100 million of the Class A common stock. And I'm going to go into some of those details today. You're waiting for my opinion on it. So I'm going to go through a couple of details, and I'll give you just a little bit of my opinions on it, in terms of what it means for them. So, real quick, some of the highlights, right? This is up to $100 million. Is that the right thing? Here's the right tab. So it's up to $100 million. It's over a 24-month period, right? It expires after 24 months. And they are actually capped. There's a number of caps in here. Well, I should say, what is the purchase price? Like, that's actually the biggest thing that you would care about as an investor, right? They're diluting. At what price are they diluting? Because if they're going to sell shares for $100 a share, I think every investor would be happy. If they're going to sell it for 50 cents a share, I think we'd all be pretty upset. How they are setting the purchase price for this is they're using the volume weighted average price, and they're giving them a 3% discount off of that. Where's it at in here? 3%? 3%? Let's see if I can find VWAP. Oh, 3.0. That's why I couldn't find it. So they the way this works, if I understand it correctly, is that Knightscope is going to basically tell them, hey, buy some of our stock, and then the next trading day, B. Riley, this company, they are going to purchase it from Knightscope at a price that is 3% discounted from the volume weighted average price of the trading on that day. And there's also some provisions in here that they can actually send it to them in the middle of the day. There's an intraday calculation. But I think in general, this is just how you should be thinking about it, right? It's basically 3% below whatever the volume weighted average price was that it traded on the NASDAQ that day. So that's sort of the purchase price. Like I say, there are a couple caps here. Number one is actually how much they can have. Knightscope can tell them to purchase at any given time. And that's basically up to 33% of the average 10-day volume for the prior 10 trading days. So they can't just tell them, hey, go buy $100 million worth of stock this one day. That's not going to happen. There are some limits on how much they can have them purchase at any point in time or on any given day. And then overall, they have some limits on how many shares. And the big thing here is there's something that I didn't quite catch and didn't quite understand. I've only read it, only had the day to skim through this, about not wanting to hold more than 20% of the stock or something. That was crazy, because they have somewhere else where they say they don't want to go above 4.99% of the outstanding shares of Class A common stock. And I think that's basically the biggest issue here for them. This is the part that I was talking about before. Feel free to read it yourself. There's something about they don't want to go above 19.99% of some other stuff, and it was confusing because they already have this statement on here that they won't buy any more than 4.99% of the Class A common stock. And I assume that's because they don't want to have to do specific reporting on their B. Riley doesn't have to do specific reporting on their holdings, because I think once you get above a 5% holding in a company, they have to file, I don't know if it's a 13G or 13D, or if it's a different form if you're a 5% holder. I think that's what it is. I think that's right. It's the 13G or 13D. I think that depends on whether you're passive or active in the company. And so then they'd have to actually file that and file every trade that they make from that point on. But that is where it is. And then they actually talk about that they won't buy more than this amount of shares. Oh, you know what? It just dawned on me, man. I feel dumb. I'm just realizing this as I'm on the stream. This is how many total shares they'll purchase. This is at a point in time of how many they'll be holding, and that is because B. Riley will probably be selling some of the stock that they buy. So that's, I guess that's probably the difference here. And they'll say that hey, we won't buy more than this many shares. Although there are some provisions here, and if I understood correctly, they're saying they won't buy more than those shares unless the price actually goes above a certain amount. So I think this might be a provision. I'm not sure why if I'm understanding it correctly, why they would have put that in. That they'll say they'll buy more if the share price was higher, and perhaps that's because they would have already made money. Because this gets me to one of the other salient bits out of this here is that B. Riley is getting free shares in order for doing this, and buying all of these shares at Knightscope's discretion. They got almost 100,000 shares, I guess today or whenever this actually goes into effect. And then depending on how much they actually purchase from Knightscope, they'll get even more shares when they buy by the time they buy $25 million worth of stock. The company B. Riley will be given almost 60,000 additional shares, like 59,333. And then if they get up to $50 million, they will get an additional just under 40,000 shares for almost a total of 200,000 shares, just a tad under. So, I mean, that's obviously nice for them to get those extra shares. Now, a couple other bits here before I then get on to sort of my thoughts. There was at least a nice statement in here somewhere that gives you faith that there is no upper limit on the price per share that they might be obligated to pay. So, if Knightscope stock moons again, it goes up to $30 and it sits there, because they say, hey, we just signed a big contract with the federal government. Knightscope can then say, great, buy some of our shares. And if it's still trading at $30, they're going to be buying at $30, not at the, $4 $4 and change that it is today. So I think, that's at least good to know that they didn't set some upper limit on this thing where they'll, get some sort of a sweetheart deal. If the stock rises a whole bunch and they say, well, we really only want to pay up to $10 a share. So, it's not like a hidden option for them in that sense. One other thing just to call out here is, like, that's I think important, is this is at the company's discretion, at Knightscope's discretion, right? They can tell them, hey, go buy some of our stock. And I think that's advantageous for Knightscope, in two different ways, right? Number one, they will dilute when they need the money, right? When they actually have a purpose for it, they'll say, hey, go buy some of our stock so we can get the cash. And it's not the other way around, right? The B. Riley doesn't get to decide when they buy. And then the other point there is that, Knightscope is going to, I trust the management is going to not want to dilute more than they have to, because they also hold a stock, right? They actually, as far as I know, they don't hold any shares that have anti-dilution provisions. So every time B. Riley buys some more shares, their portion of the company just went down, right? The CEO and all the management of Knightscope. So, I think they're going to want to dilute as little as possible. And you have to imagine that Knightscope is going to issue some of these, orders to purchase their stock when the stock tends to be, trading at sort of high values, and they're going to know when, or they can reasonably predict when the stock might go up, because they know what they're going to announce, right? When they know they're going to sign contracts, they know they're going to release a good quarterly report, stock price is going to go up. Presumably they're going to wait till after that rise, and then they're going to say, hey, go buy some of our stock when it's up. So I think that's actually pretty important. One other bit here, right? Because I know there's a lot of talk of folks manipulating the market and such. They did actually put a provision right in here where they agreed. They said, we are not going to short the stock. We are not, no entity managed or controlled by B. Riley Principal Capital. And there might even be some more statement here about their affiliates or whatever, right? But like, effectively they're saying, we won't short the stock, we promise. So hopefully that remains true, because that would be a pretty dirty trick if they shorted the stock down so that then they could buy it cheap and then they use those shares to close out their short position, right? That would be pretty horrible. One thing that they did even say is, I think it was in the longer agreement, if you click through the SEC filing, you get this one. I think they made some sort of the statement here that they've done no prior short sales. So they haven't even shorted the stock down to this point, right? So they have not directly, manipulated the stock price through short sales, is what they said. All right, I think that might be most of the salient details that I got out of that. So one thing that I wanted to say, right, overall, it's useful to think about how efficient was this versus their prior fundraising mechanisms. And I think the one interesting thing, right? I'm going to go to their reported numbers that I've gone over a little bit here. I think they spent a lot on advertising for the purposes of getting retail investors, right? Folks like you and I to know about the company and interested in investing in the company. And I did a little bit of math, right? This is what I talked about in my prior video, where you see this yellow line here. There's sales and marketing expense, and the advertising is included right in here, where you see the expense in these quarters, Q1 of 2021 and throughout this, I guess this would be Q1, this would be Q2, and those again are sort of average over the 6 month because we only have the 6 month numbers. And then Q3 dropped way down, like way down. It was down 80% or so, and then you see Q4 way up, and you ask yourself what was different. Well, throughout Q3, they were not raising funds, right? They were not issuing. I think earlier in the year they were doing this on Start Engine. Later in the year they were doing the actual public listing, the NASDAQ listing. In Q3 they did neither of those, and they call this out, right? That their increase in sales and marketing was generally because of increased advertising expenses, and I think that advertising was targeted more at investors rather than customers. And I think they even reiterated this on the recent town hall where they said, we've done some advertising and it hasn't actually worked out that well for us for generating sales. They get most of their sales, by using salespeople and having sales calls, not necessarily advertising. So I did a little bit of math and I looked at, if I assume their actual sort of baseline sales and marketing expenses are down here at about 700,000, and the difference between the 700,000 and this amount up here for this quarter, and this quarter represented that incremental spend that they did on advertising for, to try to attract investors. Here's the numbers that I roughly came up with, right? So if I look at those 3 quarters, it looks like they spent about $9.2 million, over and above what it would be if they just had sales and marketing expenses of, this 697,000 for all 4 quarters. And, during those 2 raises, during the raise on Start Engine earlier in 2021, and then the NASDAQ listing, they raised about $44.2 million, if I did my math correctly, except then they paid 7% of that in fees, right? And so they actually got $41.1 million back to the company. Then, so if you take that 41.1 million, subtract off the 9.2 million that I think they spent in advertising, they actually netted back to the company about 31.9 million, and they had to issue 4.4 million shares in order to do that. So even though the purchase price, that you and I paid were, $10 per share, they were effectively getting back, $7.25 per share. So when we're looking at this, this sale here, and we're saying this is only 3% off of the volume weighted average price, the volume weighted average price really only needs to be, in the mid 7s for it to be sort of equal to what they were raising through these prior mechanisms at $10. And so I think that's it's clearly much more efficient from that perspective. And I think that matches what you've heard from some of the comments from Bill and from, I guess it's mostly Bill, talking about, they want wider access to the capital markets. And just one other note is actually, if you take into account that some of the shares from the Start Engine raise earlier in the year had some anti-dilutive properties on those preferred Series S shares, I think it's actually more like in the low 7s, somewhere around, the number that I came up with was $7.15, right? That would be the effective share price equivalent that is equal to them raising at $10 per share when they did it on Start Engine. So yeah, that's, I think, a big point there to understand that I think this is a more efficient mechanism. And then, you can ask yourself, how dilutive is this going to be? And that's really hard to say, right? We can at least use some sort of a bound on, that 6 point whatever million shares. Yeah, they don't want to buy more than 6.8 million shares for. I don't really understand the whole rationale behind this, and that's unless the price is actually, above the $4.68 dollars per share that it had been, when they sort of executed this agreement. So I mean, if you just look at that, that right there would be, what's that, 20% of the company ish, something like that, I think. Maybe 15%. I think, when we're talking fully diluted, I guess, I mean, let me do the math in my head, right? So this was, I think, if I recall, there's about 55 million shares, where they're fully dilutive. So I guess that would be less, right? That would be more like 10%, because once they issue those 6 million shares, almost 7 million, we'd go up to above 60 million shares outstanding. So that'd be about 10% of the company, I guess, if they bought all of that. So, $100 million for, although if they're issuing those, it depends on what the stock price is, right? If they need to get the $100 million, then you're talking, we'd have to have a share price of $14.60 in order for them to get $100 million from the 6.8 million shares. Let's say again, you could do the math all day long, right? Because I don't think anybody has any clue what the share price is going to be 6 months from now, a year from now, as the company hopefully surprises us with some good news. I shouldn't say surprise, maybe we're expecting it, but it hopefully has some announcements, make some things more concrete. And so, like, this could be very dilutive, right? If the stock keeps going down and, Knightscope's hovering, in the $2 a share, which obviously I sure hope doesn't happen. But, if that's the case, this is going to be really dilutive. They're not going to get a whole lot of money out of this, right? Because they'd have to they issued this 6.8 million shares at, $2 a share. They're getting what, 13-14 million dollars, which isn't nothing. That's something to sneeze at, but that's not the $100 million that we thought it was going to be when we saw the press release. So again, I fall back on, they're well capitalized right now, right? And I've covered that before. They already have a year's worth of run right before they even touch this equity facility. And, so presumably they're going to wait until they feel that the share price is high enough that it's a good time to dilute. The other thing that they have mentioned once or twice is doing some sort of an acquisition. I don't really know about that. That would be, yeah. Well, I'll have to hold any judgment on that until I see it, because it's not obvious to me that any of that would really be a good idea for them at this point. But we'll see. Overall, is this good or is this bad for the company? I think this is good because of, sort of how I see that playing out, right? As I see this being controlled very well by management, and because I think they're going to release some positive news, right? You saw my prior videos. I think that they're going to have a sort of a revenue surprise for people who think that they haven't been growing and it's a dying company. When the Q1 numbers come out, and I have my rationale laid out for that in other videos. And I think I see the stock going up from that point, and this dilution could get us close to that $100 million if the stock price goes to where I think it will go in the not so distant future. And the fact that they can be patient in order to raise this money, because they already have 30 or 20 or 30 million dollars sitting around right now, which is I guess it was 20. Sorry, I'm thinking too far back, but because it's in their filing, right? Cash, liquidity, and capital resources. 22.3 million in mid-March, right? Just a couple weeks ago, right? So they don't need the money right now. So they can issue these equity purchases when it makes sense for them to do so. I guess this was the one other thing I didn't touch on this, I don't think, is the one thing that was not included in here is any mandated or required holding period for B. Riley with the shares. So I do think we should expect that B. Riley is going to be selling these shares that they purchased from Knightscope, right? And they even call this straight out here that the common stock that we get here, like, we might sell or distribute these from time to time. Who knows, right? Maybe they'll hold on to it for a while. It's hard to say, but there is at least no pretense that they're going to do anything other than sell it in these agreements. So that is at least something that we should expect. So there's going to be sort of a counterbalance, where they'll be issuing these equities when the price is high, and presumably if they're doing it when the price is high, B. Riley is also going to want to be selling it when the price is high. So we'll see. All right. I think that is mostly what I want to cover. See if there's anything else in the live chat. By the way, thank you. That question was well, I guess it's a comment question, whatever we call it, from Kalia. So thank you, Kalia. It looks like you hopped off, but thank you. I didn't you say it earlier? Thank you for joining. And for everybody else, I do these videos usually between somewhere around 9 to 10 p.m. Eastern U.S. time. I do most, probably, I think all of my videos so far as sort of live streams initially, and then I leave them up for everybody to watch after the fact. But I'd love to have people on here, answer questions, get some back and forth, do some discussion here. It's been great. So yeah, I have nothing else for today. So thank you very much for watching. I appreciate